Good evening, ladies and gentlemen. This is Clueless 8, end of the week report for May 18th, 2014. So these are the remaining charts that I'm going to cover tonight. So let's start off quickly with the IWM, the ETM for the the ETF for the Russell 2000. Very similar looking chart. Follow the blue uptrend line, which was broken, as we all know. This is the one that's from November 2012. Very powerful line here that we need to concentrate on. My feelings remain the same as I've explained on the Russell video, that we do have a reversal hammer here, right there, very similar to the one on in February 5th. And if this pattern plays itself, which was followed by also a green reversal hammer, and as you all know that my real-time members and subscribers benefited tremendously from my very keen observation of these type of movements based on internal divergences which have been positive or at least relatively constructive. What we need to do for this to continue up and retest these levels of 112.44 and then the 50-day at 114.11, and basically try to go to the upper end of the Bollinger at 115.98, which would be then above this uptrend line, above the 50-day line, above the 34 line. Very important is that these positive divergences are being played out, and if it mimics this particular instance back in February, as we can see, this is called pattern symmetry. If we can cross over decisively on the MACD lines, then we are going to have that run up. We have yet to see what happens. On the downside, if we do break this very critical support level of 107 or 107.15, we have a lot of room to fall. We could fall anywhere here. We could come down to about 103, which was the last major reversal point here, as you can see right here. But we'll cover that, some other time, more in detail as the market unfolds itself this week. So we do need a side of turn here to mimic this, and then we go. Let's move on to the spider, the SPY. Same story as the SPX, obviously. And as we can clearly see, the downtrend line is here. Unless we have a decisive break of 182, we are still on a multi-year uptrend all the way from 2012. Okay, it's just clearly shown here. There's nothing to be explained. And we do have Bollinger movements here on the upper side. Same old story. This one bounced off the 34. The 50 is here. Let me make this a little bit thicker so we can concentrate on it. Here's the 50, here's the 34, bounced off both. We're moving up here. This is looking pretty constructive. As I've said, this is the stronger of the indices versus the NASDAQ and the Russell. So we have a couple of rooms. We could basically go and test the highs at 190. We could come to this acceleration Bollinger Band up here, 189.74. We have quite a few little points that we need to kiss and touch. If we do go over, I believe if we do go over the 189 level, or at least the 189.20 level, then at that point we have the momentum to carry us and make some new highs at that 191.52, which correlates with the 1910 or 1920 level on the S&P that I've covered before, and has been bandied about also by some very serious technicians out there. So chart is still constructive. We are not seeing any major breakdown here. We do need the RSI to turn up, but OBV, which is a good indicator of net buying minus net, selling, buying minus selling volume, on balance volume is net positive. As you can clearly see, it's still pointing up. So a lot of things can happen. So let's keep an eye on that. Let's move on to the next index, which is the NASDAQ Biotechnology Index. Very, very important again. Daily chart from November. Uptrend line was breached. significant here. This is the one, this was the catalyst that started the big sell-off on the Nasdaq, the most leveraged part of the market, the most where the gamblers delight. Just drawing a line here to show everyone. So here we are. We slipped below the. We don't have the thing. The moving average here. 1 second. Gotta put that through. Okay, the black line is a 200-day moving average. We slipped below that. We had a very sharp reversal of that. We have gone, this is substantially positive. Look at these MACDs crossing over with some serious violence on the upside. So we basically moved up from 207 all the way up to 236, consolidated, tested the uptrend line, classic technical behavior, I would say positive behavior, and then now we went up, tested the triple top here at around 234, which I've talked about before. We need to now take out that 234 if we are going to be constructive moving up above the 235 level on the IBB. Do monitor that on your daily charts, and then we have some room to move here up to the 246 level. Above the 246 the trend turns up, so that's quite a bit away, but these Bollingers, if you look carefully, are starting to get narrow, and if they start to curl up, then you have a very constructive pattern. On the downside, if we break below this line again, the uptrend line, test the 217. After that, I believe it's going to be a free fall down to the 197 level, and probably up to this point where we had the last hammer reversal, and that's at 191. So saying all that, internals are constructive, and there's a possibility that it goes and touches the 236 level, tests the 50-day, and then from that point on we see what happens. Let's look at the 10-year Treasury yield. I've talked about it extensively. I tried to educate people a little bit about what's going on. My gut feeling remains the same. The money flowing into the 10-year is not a indication that the U.S. economy is going into a recession or the global economy is going into recession. I believe there's money that is being parked there. There was a massive parked there by foreign investors. That's one reason, small reason. The big reason is we had a large technical move. Treasury prices were squeezed up in a dramatic fashion because everybody and their grandmas thought the treasury prices would keep on going down and yields would keep on going higher. And obviously that would be a very negative effect on the U.S. economy if yields kept on shooting higher. And I'll show you on a weekly chart that if we do cross over 3%, which we touched briefly up here on in January, do we tend to have a pretty massive sell-off. If you remember, January was a very ugly month, and that's exactly the point where the Treasury yield touched 3%. Look here, okay, just move the decimal up one bit. So I don't understand quite. Maybe I do understand the games that the market plays and the media plays and a lot of analysts play. Is that why a higher Treasury yield is that conducive to the market? It is not. In fact, the level that is reached right now at well below 2.5% is a significant support, which I've shown again on my work during the week. Is a significant support which ensued was the onset of a major rally back in late October 2013. So we could be on the verge of that here if we hold the 2.5 level, which I believe we will, and then we move up, and looks like we're starting to do so. The internals are very hard to read, and I'm not really going to go there. Okay, there's showing that it's weak, and I have a difficult time reading the internals on the TNX or the 10-year Treasury yield. So let's stick to the chart itself. So here we are. I believe we're going to come down and test this level 2.685, and right here 2.68. I don't want to bog down people with too much about the credit markets. I am just a passive student of fixed income. I don't trade fixed income. I just look at it as a proxy to what's happening on the equity markets and the overall economy. But I do believe that at this point, the 10-year, which is basically the main is the rate that all other rates are calculated off, including the most important housing mortgage rates. is going to be a positive catalyst going forward. We obviously don't need to have a collapse in treasury yields down below. That means a lot of money is moving into US government treasuries, and that wouldn't be any good. But then at the same time, right now, it makes a lot of sense to be involved in high quality dividend paying S&P stocks, which are yielding um, much higher than this 2.4%. So again, one has to basically figure out what they're doing. So saying all that, I do not believe that gotta move this down. So saying all that, I do not believe that the treasury situation is anything to be that alarmed about, despite what the media makes out of it. We are not going to go into recession, in my opinion, from everything that I've seen. And again, this was a massive short squeeze that happened, a technical move, and of course, one must monitor it. That's my take on that. So that's all for the indices chart. Now we're going to go into some equities in the next one.